Good morning. It is Monday, September 29th, 2025. I'm Herb Morgan, Senior Managing Director here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. If you want to hear me intra-week, if something comes up that's interesting, best to just look at and subscribe or follow on LinkedIn, Herb Morgan, pretty simple, or on X at Herb W. Morgan. This presentation you're seeing and hearing is developed by me. It's designed to be used by you, whether you are an investment advisor, a financial advisor, or an individual investor. Doesn't matter which, but you're all expected to make your own investment decisions. Nothing in the presentation should be treated as investment advice, as tax advice, or as a recommendation for the purchase or sale of any security. Any views expressed in here are mine, and they may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Let's start with last week. Just another good old week for equity prices. You can see there S&P, big cap leading the way, which means tech leading the way because big cap is tech and tech is big cap. 1.25% on the week, bringing the year-to-date gains to a healthy number, 14%. We're ending the quarter this week, but if we were ending the year, I'd still say we'd look back and say 2025 was a very good year for risk assets, stocks, and bonds. You look down below at fixed income markets and you can see good returns there as well, although rates did kick a little higher last week, sort of the buy the rumor, sell the fact in the week after the very small Fed rate cut on the ultra short Fed funds rate that took place the week before of 25 basis points. And our alternative assets for the year, of course, are doing what they're supposed to do, which is to be uncorrelated to stocks and bonds and just deliver solid absolute return results. Let's get into economic data released last week because it all matters. We got the flash reading for September manufacturing. The S&P Global's PMI reading for September fell from 53 to 52. 52 is above 50. That means economic expansion, pretty much in line with the estimate of 52.2. Later this week, we will get the final reading, but this flash reading suggests that it was a pretty good month for manufacturing. Of course, if we get the manufacturing reading, by the way, manufacturing about 15% or so of the U.S. economy, services about 85% of the U.S. economy. The services number was pretty good as well, 53.9, right in line with the estimate of 54, just a tad below the 54.5 number reserved in August. And here again, we will get the final reading later this week. We had a surprise positive jump in new home sales. It was a pretty big jump. It was a 20.5% increase to an annualized pace of 800,000, well above the 650,000 annual rate. I believe this is firmly people saying, okay, let's get in, let's lock in interest rates. Interest rates had come down in advance of, in anticipation of the Fed cutting their very short-term rate. We even saw the 10-year click just below 4% there very, very briefly. And that alone was enough to trigger some new home sales for the month of August. In addition to new home sales, of course, we got existing home sales. They remain very, very low. Annualized pace is in that 4 million range. Used to be in the 6 million range. Fell 0.2%, just up ever so slightly from a year ago. The problem with both new and existing remains affordability. Affordability, I think a lot of it's being blamed on rates, but in reality, interest rates are really kind of average. They're kind of where they've been for the majority of our lives. They're just above where they were during the crisis of 2008 and the crisis of 2020 that was related to COVID. But the other costs of production remain very high, whether it's land acquisition, plumbing and utilities, park fees, impact fees, school fees, bio-study fees. All of these things go into the price and are passed on. Increased regulatory requirements for energy efficiency, earthquake efficiency out here in California. These are all very expensive items. And the bottom line is home prices are still pricing out a very significant percentage of Americans. Weekly claims for unemployment on the good news side really plummeted 218. Estimate was 233. Continuing claims still staying in that low, just below 2 million range. You can see that here. Remember that spike was a fraud in Texas. That has now been fully reversed, and we're back down at this low level of around 220, which is just a great, great number. It shows strength in the labor market. But strength in the labor market means there's really no reason the Fed should be cutting interest rates because they're still above their target rate of inflation, which is core PCE at 2%. So they thought they had weakness or softness in the labor market. Turns out they might not, although, again, we have seen those monthly jobs numbers be softer. So there can be that argument made. We will get another jobs report here on Friday for the month of September. We move on to GDP, the revised GDP for the second quarter. That's the quarter that ended June 30th. It was a big upward revision from 3.3 to 3.8. That's really a very, very good number. It was the highest reading since the third quarter of 23. That's 2 year. The second highest reading since 2021. And the good news is this wasn't sort of upward revisions to government spending or simply a closing of the trade gap. It was personal consumption up. And more important than anything, business investment, right? You've heard me say over and over, this is what the administration's trying to do. They're trying to stimulate the growth of the economy, not through borrowing and spending, not through monetary accommodation, although they are jawboning to get short-term rates lower for a different reason. They're trying to inspire investment. The One Big Beautiful Bill Act was meant to do that, but the trade negotiations and the tariff negotiations all have come along with either corporate investment commitments into the U.S., CapEx. The thing about CapEx is it's considered to have the highest multiple for future economic activity and future economic growth. In addition to the corporate CapEx from foreign and domestic companies, they've been actively encouraging CapEx from sovereign foreign entities, and we are starting to see that. Business investment grew 7.3% in the second quarter. That's actually sooner than I would have thought. I still think we have more to come on that regard. Spending on services, again, 85% of the economy, also revised higher to 2.6% growth. This is truly a great number, which explains things like an all-time high in equity prices last week. Durable goods numbers, which are volatile because of large aircraft orders, they were up 2.9%. If you back out transportation, they still rose 4% on top of a 1% gain last month. So that was a good report. Personal income for the month of August. Remember, this is Q3 data we're looking at, which will go into the Q3 GDP report, which will be coming up because we're ending Q3 here this week. Personal income here gained 0.4%. That's a great number, 5% higher than a year ago. Personal spending also up 0.6 and up 5.6 on a year-over-year basis. No sign of a recession here. This is great news for the economy. And surprisingly, though, consumers are saying, well, we're not quite positive about it. We're seeing great data, but we're concerned. Why are consumers concerned? They're concerned because of the cost of living. It's gasoline prices, it's energy prices, it's utilities, it's insurance, it's food, it's shelter, and it's clothing. That is the big issue of the day. It is inflation. Yet the Fed cut interest rates last week or 2 weeks ago now. Consumer sentiment fell to 55.1. The estimate was right there at 55.4. Current conditions fell and expectations fell. So the bottom line is the economy is strong. The economy is doing well, but we have this persistent inflation. I believe this persistent inflation is due to persistent fiscal deficits more than the growth in economic activity. Lowering interest rates, really all it did was give cover to these persistent fiscal deficits. The reality is the Congress needs to get serious about closing those fiscal deficits. I have to applaud the administration. They're doing things like DOGE. And admittedly, DOGE really can only impact certain parts, right? If 15% of the budget is defense, and both sides generally agree on that, about 15% is interest on the debt. That's just driven by market forces. We're now at 30. 55% is roughly the entitlement spending of Social Security and Medicare. Not much you can do about that, but DOGE did attempt to remove people who were not legally eligible. That helps a little. And then they focus on that other 15% of the pie chart of the government spending and try to do away with fraudulent expenditures such as USAID. But to remember, the way our system works, if the money's allocated, it must be spent. The only way you can bring it back is with legislation. You have to have a rescission bill. Otherwise, whoever runs that department must spend all the money. No incentive, no way to save money, even if it means delivering better results. That's just the way our system works. So, what happens? It gives you inflation. Who pays the hardest price for inflation? People without assets like stocks and real estate. If you have stocks in real estate, you go up in response to inflation. If you own a business, you raise the fee. If you're getting, if you're a high earner, you generally will get some raises. But it's the people at the lower end of the economic spectrum that do not have the assets, do not have the real estate, do not have the stocks and bonds. Those are the people getting hurt by inflation. The inflation is being directly caused by deficit spending and being enabled by a Federal Reserve that just lowered interest rates. Okay, I'm off my soapbox. Personal consumption expenditures, or core PC inflation, remains well above the Fed's target, yet they're still cutting interest rates. PCE price index up 0.3% in August, 2.7% from a year-over-year basis. Core, the one that matters the most, up another 0.2%, and 2.9% year-over-year. Here we are in the fall. Some tough months from a year ago are going to start to roll off, but we've got to replace them with low months. We've got to be at 0.1 or 0.0 or negative in order to get that core number down. A lot of people think that the Fed has simply abandoned the 2% core PCE inflation target, and they might not be wrong. Now, they're not going to explicitly say it. They're going to say we continue to look at the 2%, and oh, by the way, we're concerned about the labor market getting soft. To be fair, some of the jobs markets have reports, the monthly reports, which we'll get to later this week, have been soft. But weekly claims for unemployment are not. Layoffs are not. Job openings are still strong. So we will likely see continued 2% more than the 2% core PCE inflation. And let's talk about stocks and bonds, and let's talk about valuation. One of the simplest and easiest ways, and actually a fairly effective way to look at valuation, is to look at the yield at the 10-year U.S. Treasury. What do you get for taking no risk? You get 4.14% this morning. Well, what do you get on a yield, the earnings yield of the S&P 500, for taking risk? You get less. You get 3.62% as of this morning. So when the risk-free yield is above the earnings yield, you can say that stocks might be a little overvalued, or you could say that bonds are undervalued. But remember this, the earnings, not the earn-ins, but the earnings of the S&P 500 are variable, not like a fixed rate coupon on a 10-year treasury. So here we are at the end of the quarter. We are 7 or 8 days from the earnings season beginning. We'll begin with the financials. We'll roll into the other names, including the big cap tech names. And if those numbers come in well above expectations, then maybe stocks weren't as overvalued as they appear. And if inflation ever comes down, then you've got a good solid return in the fixed income securities or the bond securities. Speaking of inflation, it does remain pretty high. This is that same 10-year Treasury yield that I just showed you, 4.14%, coupled with the break-even yield. This is a yield that's traded in the financial and capital markets where people are literally betting on what the inflation rate will be. And as you can see, after the huge COVID surge, I shouldn't say the COVID surge, it was the ridiculous monetary and fiscal stimulus above and beyond anything we'd ever seen in human history that caused the inflation. The inflation has moderated, but it hasn't really changed in about 3 years. We've been at 3 years well above target. And this is what people are betting will be. So therefore, you're actually getting a very sizable premium above inflation for owning 10-year treasuries. So this makes the argument that bonds are pretty attractive investments right now. If you could get 4%, inflation comes in at 2.3 over the next 10 years, you made a pretty good real return. If inflation actually goes back down to target, you made an even better real return, and you could get some appreciation. in potential from those bonds or fixed income securities. So take it for a grain of salt. I wouldn't want to be short this market despite it being overvalued as we move into earnings season. Lots of economic data this week. Pending home sales this morning. Okay, great. Then we've got FHA and Case-Shiller home prices, Chicago PMI, the JOLTS report, jobs openings, still pretty healthy here. Consumer confidence, that's after we had the Michigan one. This is the conference boards. Consumer confidence. Then on Wednesday, ADP's employment number still expected to be small at 50,000. Final readings, S&P Global, ISM Manufacturing, S&P Global's manufacturing and ISM Manufacturing. Construction spending, auto sales on Wednesday. Thursday, jobless claims expected low. Factory orders expected to be up a tenth. And then non-farm payrolls, that's the BLS, Bureau of Labor Statistics report, 50,000, expecting unemployment at 4. If that number comes in weak again like that, yes, the Fed will probably cut again on October 29th, 1 month from today. That number spikes up higher, or if the 4.3 drops to a 4.2 or 4.1, then the cut in interest rates for October 29th is pushed out further, in my opinion. Services sector but remains strong. We'll hear from S&P and ISM on Friday. Thanks, everybody. I'll be back to you again 1 week. Goodbye.